Reserve Bank of India has released its financial stability report. The central bank expects asset quality to deteriorate marginally in the next financial year, even in its best-case scenario, according to stress test results. It's also warned about a sharp rise in retail write-offs, especially at private banks, which could be making bad asset quality. Ritu is joining us now with the details of the financial stability report. Ritu, take us through what the RBI is red flagging, the chief concerns it raises.
Well, I'll start with some of the key risks that, RBI has really flagged in this report, starting with the retail loan segment, where RBI points out that while the retail segment gross NPAs at 1.2% are stable so far, the bad loans in the unsecured segment within retail are higher at 1.7%, with more than 50% of retail slippages across the system coming from this unsecured segment. But what is more concerning, says RBI, is the sharp rise in retail loan write-offs, particularly by private banks, which could be masking deeper issues like bad asset quality and weak underwriting standards. Microfinance is another area of strain. Stressed assets, which is those overdue between 31 and 180 days, more than doubled in just 6 months, rising to 4.3% as of September, and borrower indebtedness is also climbing. So nearly 6% of borrowers now have loans from 4 or more lenders, compared to just 3.6% 3 years ago, and loan sizes have also ballooned in this category, up 43% in just 3 years on average. In consumer credit, again, the report says around half of credit card and personal loan borrowers are juggling another high-ticket loan, so smaller personal loans are also putting secured larger loans at risk, because keep in mind, if a default in any loan category happens, it results in other loans of the same borrower also being tagged as an NPA. Now, if we look at RBI's stress test results, they're not projections, but they're based on hypothetical scenarios. They suggest gross NPAs could more than double from 2.6% in September to 5.3% by March 2026 under an adverse case scenario, with public sector banks being the most vulnerable. Even in the base case, NPAs are expected to rise in the coming year, which is an important indicator to keep in mind. Capital adequacy remains resilient at 16.6%, but it could drop all the way to 14.3% under a severe scenario. As for NBFCs, the stress test shows that gross NPAs could rise sharply from 2.9% to 6% under high stress, while capital adequacy could fall to 20.2%. But alarmingly, 15 NBFCs could even fail to meet the minimum capital requirement if severe risks materialize. So overall, it's a mixed picture. On one hand, you have the system, which is resilient, but on the other hand, there are serious vulnerabilities which are emerging across retail, microfinance, and consumer credit.
All right, Ritu, many thanks for joining us. That's the latest there as far as the RBI's financial stability report is concerned. The big corporate story.